Welcome to the third video in this PPP series, where Maurice looks at the SPV, which stands for Special Purpose Vehicle, and sometimes can be called a Special Project Vehicle, and it's a key feature of most PPPs. I hope you enjoy these videos and they help you in your understanding of PPP and the CP3P syllabus and standard. Please click subscribe and be the first to see the next series of PPP and CP3P related videos. Thank you.
Hello, this is the CP3P Simple Introduction to Infrastructure Financing and Structuring. This session is going to look at investors. So investors in the special purpose vehicles are usually the companies involved in the winning bidding consortium, so normally comprising a construction company and a services management company. The commercial banks, and we may also have the multilateral development banks involved, the national development banks and export credit agencies involved in some way or other, and institutional investors such as pension funds, life insurance companies, sovereign wealth and superannuation funds. Now, the institutional investors may invest through infrastructure funds as limited partners, or they may actually provide bond finance. If they are going to provide a bond finance, they really only want to get involved in a deal when it's relatively risk-free. So when is that? Well, I think we now know that we would be looking at a period post-construction for an asset and service-based PPP, for that design, build, finance, operate and maintain. So the institutional investors, such as the pension funds, are people who actually will be looking after your and my pension. So we wouldn't want them to invest in high risk businesses, because that's our money, the money we're going to be living off when we retire. So they will come in after the construction phase. So how would that work? Well, the commercial banks will provide that short-term debt, that 5-year debt, and then after the construction is completed, that will be repaid by raising finance through the bond, and then that bond will be in place through to the term of the contract, and indeed that bond can be traded. Then we actually have our infrastructure funds and government itself. Now, there is a view that, or indeed a concern, that by the private sector, that they don't actually want the government to be an equity shareholder in an SPV, because they don't believe that the government would necessarily understand the private sector way of doing business, the need for a particular return and so on. Now, that is maybe a concern of the private sector. As to whether or not it's a sensible view is another matter. However, normally we would see that governments could put money in through a grant, through a loan, or indeed through that equity share, or through assets in kind. So we would look at maybe land that's been contributed to the PPP, and in return the government is seeking a seat at the table on the board. Now, the infrastructure funds themselves are a good way for governments to invest in a PPP, because then essentially it's being done through a third party. We don't really want the department that signed the contract with the PPP to then also be a shareholder, because there's a clear conflict of interest there. So better that we actually have that investment, that equity investment or that loan being done by a part of government that is outside the departmental structure and outside the contracting partners. So there we have it. Our consortium members, who are now the equity shareholders of the SPV, the construction company, the service management company. There may be some institutional investors, commercial banks, of course, and indeed even the government. So let's look at some important benefits that project finance does in fact provide. So first of all, the public sector will benefit from the lender's oversight of the project governance and performance, which is inherent in the technique. That's why we're doing it. As project cash flows are the sole basis to recover the loan, that cash flow reliability is clearly at the heart of the project finance. Lenders will therefore add an additional layer of due diligence to the government appraisal and the bidder's own due diligence of the project. The project finance allows the sponsors to raise third-party funds without being directly liable to the lenders. Therefore, this frees higher equity capacity to invest in even more projects, such as PPP projects, while maintaining a healthy financial structure at the corporate holding level. For these reasons, the public sector needs to pay attention to bankability when appraising and structuring the PPP project. Bankability is an intrinsic element of commercial feasibility. So, bankability of a project could be defined as the level of willingness of prospective lenders to finance the project. That is, what amount and under what conditions. Higher bankability means access to more funding or better conditions in terms of the amount of debt or leverage, the loan term, and the loan costs. Debt amounts and therefore gearing will depend on the projected cash available each year for debt service, therefore on the amount of revenue projected and reviewed by lenders and/or its advisors under a due diligence process and its reliability. However, if prospective lenders consider the project to have an unacceptable level of risk and uncertainty, they will not provide finance and the project will not be bankable. So just a few more things to think about. Project finance, of course, is a useful tool for companies that prefer to finance a project in an off-balance sheet manner. That means off-balance sheet to themselves, thereby avoiding the need to issue corporate repayment guarantees. Project finance rules also allows the sponsor, the parent company, to extend their debt capacity by enabling the sponsor to finance the project using third-party credit, which could be the purchaser of the project's outputs. Sponsors can raise funding for the project simply based on secure contractual commitments. Project finance permits the sponsors to share the project risk with other stakeholders. And the basic structure of project finance requires the sponsors to spread their risk. This helps in reducing the risk exposure of the project company itself. Now, finally, let's look at those major concerns of the project lenders. This is adapted from a World Bank source and is in box 1.23 of the CP3P Book of Knowledge, Chapter 1 of the APMG Guide. So number one, the need for certainty about the project cash flows needed to meet debt service requirements. This is why it's so important to make sure our financial model is sound and that our estimates, our demand estimates and so on, are also well thought through. Two, sufficiency of the project cash flows for making the expected or at least a reasonable profit for the equity investor. Three, creditworthiness of the public sector in terms of meeting its obligations, soundness and stability of the legal framework for PPPs. Four, confidence in the regulatory regime. 5. Effectiveness and enforceability of the PPP contract and related agreements. 6. The right to step in if a project fails. Do you remember that direct letter or direct agreement between the public sector partner and the lender? And then the availability of alternative contractors. If the bank does step in, is there somebody that the bank can put in place who would be able to operate this PPP effectively? Do they have the experience and knowledge of the sector, and in particular, this level and type of service arrangement? Number 7, the ability of contractors to perform and the quality of their management. Number 8, creditworthiness of the contractors and the quality of their guarantees. So not just the creditworthiness of the public sector, but also the contractors themselves. Number 9, the risks must be understandable, controllable, finite, and appropriately allocated. Number 10, acceptability of the termination regime, providing sufficient protection to the debt. Number 11, the reputation impact of the project. That's the environmental and socio-economic feasibility studies. Number 12, the availability and effectiveness of insurance coverage. That brings us to the end of our 3 presentations on project finance, the special purpose vehicle, and public-private partnerships. Thank you for listening.